Greetings, everyone. Scott Richardson, Dan Brown from Richardson Capital Management, here to provide the May 2026 Economic and Investment Update. So, we had quite a month in the financial markets again. The stock markets across the globe have been performing very favorably the past couple of months, and they were up strongly again in May. The advances, I would say, are quite broad based, whether it's US, international, emerging markets, large cap, small cap, pretty much across the board. The equity markets have really been on a tear the last 2 months and continued that again in May. The fixed income markets, on the other hand, were pretty flat during the month. Interest rates stayed relatively steady, so we're pretty flat there. And the other item that we had some movement on during the month was the price of oil moved fairly significantly. I think, as everyone knows, the price of oil has been a little volatile this year, given everything going on in the Middle East and the conflict in Iran. And at the beginning of the month, West Texas Intermediate (WTI) was trading at about $106 a barrel. I think it's going to end the month about slightly under 90 in the high 80 range. So a pretty meaningful decrease in the price of oil over the course of the month. That clearly played into what helped the financial markets partially, but there are certainly other aspects that impacted what's going on in the financial markets as well. And then during the month of May, we had some news on the Federal Reserve front, right? We got a new Fed chairman. So we're going to talk a little bit about that as well and the implications there. But I think to get started, let's talk about what's driving the performance of the financial markets, given that we've still got a lot of headwinds going on here. And there's clearly a couple main drivers, earnings being one of them. And I'll let Dan talk a little bit about what's going on there.
Yeah, I think the earnings growth is the main driver. So another second consecutive months of positive returns in the stock market, April and May. And in May, we saw the conclusion of first quarter earnings reporting season, and the results were extremely strong. It's kind of hard to remember a quarter that was so strong. So we entered the quarter with expectations for about first quarter earnings growth of 14%, and we ended the quarter at about 29%. So basically double expectations. And the results were really broad based, both from a top line revenue growth standpoint, and you really saw meaningful earning surprises pretty much for almost every economic sector. Technology led the way with by far the biggest earnings growth. A lot of that is just the continuation of the build out of the artificial intelligence and data center theme. But again, there's other sectors that are participating in that, namely industrials and utilities. And kind of an interesting phenomenon that we saw the past couple months is with the strong advances in the stock market, you would think that valuation ratios would look somewhat expensive. And we've kind of seen the opposite phenomenon play out because, the PE ratio, price on top, earnings on the bottom. You see the earnings growth so strong that the valuation multiples have actually, decreased or contracted a little bit, which I don't think most people would intuitively realize. But again, another strong phenomenon that's driving the equity markets here.
Let's shift gears and talk a little bit about the Federal Reserve and the outlook for interest rates. As I mentioned earlier, we've got a new chairman of the Federal Reserve, Kevin Warsh, confirmed earlier this month. So we got a little bit of a changing of the guard there. I think some folks maybe thought there might be a bit of a shift in the kind of outlook for where interest rates would go as a result of that, but we've had clearly some major changes in the world order in the last several months that have kind of impacted things. Can you give us kind of a feel for, where expectations were and kind of where they are now as far as where we're looking for interest rates?
Yeah, so to start the year, financial markets were pricing in with a pretty high probability of a 2 to 3 quarter point rate cuts. So totaling about 0.5% to 0.75% rate cuts for the full year 2026. And we feel pretty good about that too, mainly because the labor markets were a little bit on shaky ground, and inflation was trending in the right direction, meaning lower. It was a little bit of a bumpy ride lower, but nonetheless, the trend was intact. And then fast forward to today, and we see that those expectations have changed quite a bit, mainly because inflation has spiked due to the military conflict in Iran, which has spiked energy prices, which has led to a pretty meaningful surge in inflation the past couple months. So just to remind our readers and listeners, the Fed has a dual mandate. So it focuses on two objectives. The first is, the labor markets. They want, healthy and full employment. And we think we've checked that box. The unemployment rate about 4.3%. We see, weekly unemployment claims staying very tame. So we feel pretty good about that. But the inflation is definitely a concern for the Fed, and they've expressed that on numerous occasions. So we think what this means for the financial markets is that the Fed is probably going to be on pause here for a while. So the graph that we're showing here is just showing the Fed's interest rate easing campaign. So we saw a series of cuts in late 2024, early 2025, and then a fairly long pause, and then a couple more cuts in 2025, and then projecting out what the current probability is versus the probability that existed earlier in the year. And normally this would upset the financial markets quite a bit. The fact that these probabilities change so much so quickly. But again, as we talked about already, the earnings growth profile is very, very strong, and we think that it's going to continue throughout the remainder of the year. So basically, I think investors have come to the conclusion this isn't as big of a deal as it normally would be because the economy is on fairly strong footing and the earnings growth is coming through at a fairly meaningful pace. So it's strong enough to support the economy. So we're not terribly concerned about this. And we don't think that a Fed rate hike is actually in store. The market tends to overreact in the wrong direction fairly quickly, fairly rapidly. But again, still thinking that higher rates are not really in store here for the financial markets.
Key takeaway from that is the fact that the expectation going forward shouldn't be for significant rate cuts. Probably not going to see rate increases, at least in our opinion. So pretty steady state for certainly the next 4, 5, 6 months, I would think, before we'd see any move. Yeah.
Yeah, so we still feel pretty good about the outlook going forward here. And the biggest theme is just the earnings growth that we talked about. So we think, economic growth is intact as far as, GDP is concerned. Maybe we trend the year around 2.5% growth. The economy doesn't need the Federal Reserve interest rate cuts that we were expecting at the beginning of the year. And again, the biggest story is the fact that, revenue and earnings growth continues to be pretty strong. We think that'll remain intact for the remainder of the year.
And while we feel pretty positive, I would say we shouldn't be expecting returns like we've seen the last 2 months off kind of the sell off,
Yeah.
but certainly still feeling very good about the environment going forward at this point. Obviously, a lot can change, but hopefully we get some resolution on the Iran conflict and the oil, and that should hopefully settle markets down and we get back to kind of more of our normal steady state. So with that, we want to thank everyone for joining us. As always, we appreciate your trust and support. And if you have any questions or concerns, please don't hesitate to reach out to us.